So moving into content producers, which ones and why?
Well, I think there's two big trends going on in technology this year. The first is you've got a bunch of new over-the-top video services coming out to compete with Netflix. So we obviously heard about Apple in late March. Disney's this Thursday. They have their investor day talking about their new over-the-top streaming service. You've got Time Warner Media coming up later this year, and then Comcast early next year. So all of these guys are going to need a lot of content. You know, we're actually in CBS, we own Viacom, we own Discovery, we own Lionsgate, because the one thing you're going to need is you're going to need a lot of high-quality content, and you've been really suffering for the last several years as people have, cut the cord, so to speak. And then the second big trend is video games. So you've got the big internet giants there, Microsoft, Google, Amazon, Apple. They're all planning on trying to become the Netflix of gaming. And, we've had lots of issues there with the whole free-to-play movement. We own Electronic Arts because we think they're going to do incredibly well. They've got a great new free-to-play game, Apex Legends. So that's what we're kind of moving to and from a lot of the internet giants out there.
You think Netflix is priced for perfection here as these other would-be rivals start to find their legs?
Well, I mean, I think it's price to perfection is maybe not the way I think about it, because, valuations can go to any level you want. I mean, I lived through 1999, so did you. You can get to absolutely crazy valuations. The problem with Netflix is you've got four guys with lots of capital between Apple, Disney, Time Warner, which is owned by AT&T, and Comcast, all getting into that business. So if you're Netflix, I just don't think you're going to be able to grow nearly as fast. And to your point, it is priced at a very high valuation. They're going to lose $3 billion in cash flow this year. They're not making profits on a cash flow basis. They're going to need their own content. The latest Disney movies aren't, Captain Marvel isn't going to be on Netflix. It's the first one. Avengers Endgame isn't going to be. And so, you watch Netflix to get content. I certainly like my superhero movies. I'll probably end up, maybe picking up Disney. So for their streaming service. So I think, that causes a lot of problems if you're the incumbent.
Dan, this insatiable appetite for content, do you think this is going to continue to drive more M&A? And if so, what and where?
That's a great question. And I really do think so. Because if you look at the guys who are getting into this business and you say, all right, well, how big are they? And you look at the combined size, especially in video gaming, let's say, you look at Microsoft and Google, Amazon, Apple, you've got $3.6 trillion in market cap, and these stocks on average are down about 8% from their 52-week high. If you kind of look at the big video game vendors, they're a lot smaller in size. I mean, Activision, Electronic Arts, Take-Two, Ubisoft, they've got a combined market cap of about $85 billion. Those stocks are down 35% on average. If you look at the media companies, the four smaller ones, CBS, Viacom, Discovery, Lionsgate, they've got a combined market cap of $55 billion. Those stocks are down 21% from their highs. So I really do think there's going to be a fair bit of M&A at some point, because that streaming service Apple announced, that's not going to gain any traction. They don't have enough content. So if they're smart, they're going to pick up somebody and merge it in to try to give them something to be able to compete. And I think you can see that in general.
Hey, Dan, it's John Ford. It's not clear to me exactly how you're distinguishing between these different types of content producers. I mean, some of them are running platforms, and they have data about what their user base might want, what they're watching, and they're going out fishing in Hollywood for that type of content. Are you talking about these platforms that are generating data and interfaces that are able to be smarter about what content they are then pulling out and presenting, or the actual on-the-ground producers of the content who don't necessarily have great data about who's viewing it, but have a track record for producing good stuff?
Well, it's the latter, right? So if you've got a lot of companies that all want to be the Netflix of gaming, well, you need games. Apple doesn't have any games, right? So you're going to need to get that into your universe. Or if you're looking at streaming video, well, Netflix has got a ton of content that they produce. Well, if you're Apple again, you don't have any. You're going to need to get some. And so, the prior segment you had, you talked about regulation against these big internet companies. We all saw how Microsoft performed when they went through a 10-year battle with the U.S. Department of Justice. The stock declined, I think, 18% over 10 years when they were in the midst of this, versus the NASDAQ up 65% or so. And so, that's going to also weigh on this as you have more regulation. So, and the nice thing is, people hate these companies that I'm involved in. I mean, CBS, Viacom, Discovery, Lionsgate. I mean, people have been talking about cord cutting for several years, ever since ESPN started to lose subscribers. You're now finally, after several years, moving in the other direction. Same thing for the video game companies like Electronic Arts. Ever since Fortnite came out, people have been switching to free-to-play. Electronic Arts finally has a good free-to-play game. So that's how I'm kind of thinking about it, John, is, everybody loves the names we just talked about, the Microsofts, Googles, Amazons, Apples, for the most part. But these other names are pretty unloved, reasonable valuations, but the big giants are going to need their content.